to do is talk about or begin with setting the context. And to do that, obviously, what we'll do is we'll talk about the global context and how that's going to impact Pakistan. Now, I'm sure, obviously, all of you are familiar with the global context. I mean, I don't need to go over this, but I think it sets or it anchors the discussion that we are going to be having. So I think it's important to start off with that context setting. Now, obviously, I think it goes without saying that we are in uncharted territory. What's happened is, in terms of the fear, the uncertainty, and the disruption that's been caused, this is unprecedented in our lifetimes. So clearly, we're dealing with something that we're not very familiar with. Now, unfortunately, this crisis has come about at a time when there was already weakness in the global economy. There was growing weakness in the global economy. And this has therefore compounded pre-existing worries, whether they were emanating from the impact of the China-US trade war or China's slowdown. Of course, prior to the latest agreement, the collapse of the OPEC Plus agreement for a while, which added to worries on the financial markets. So generally, we have a risk-off environment. Overall terms, of course, there's some days, there's a huge amount of volatility, which everybody is familiar with. But generally, I think it's safe to say that we are in a risk-off environment and there is a flight to safety. Now, this is not real-time, so I'm not sharing real-time data with you. This is something you're all familiar with, but this is indicative. These two panels on this slide and two panels on the following slide basically are meant to be indicative and to set the context. So we've seen very high levels of uncertainty, and this is captured by the World Uncertainty Index, which you see in the top panel. And of course, for a while in early March, we had, when there was extreme fear on the markets and extreme flight to safety, we had the entire US yield curve up to 30 years under 1%. So that really is also indicative of how things have changed on the markets. So this is obviously a very selective view. Some of the indicators that I sort of track or I like. And on this slide, on the upper panel, you'll see the copper gold price ratio. And clearly, this is an indication of whether the outlook for the market is bearish or bullish. Copper has fallen. Gold is in pretty much in demand. So once again, an indication from the markets that how they're viewing the economy ahead. And this is another good indicator, Fear and Greed Index, which I use every now and then from CNN Money. And this is actually about 10 days old. So this was moving from extreme fear to fear then, but this is pretty much where it's been oscillating. Now, we spoke about uncertainty in general terms a few slides earlier, but when we talk about uncertainty surrounding pandemics, then there's a separate sub-index of the Global Uncertainty Index, which captures this. And the takeaway from this slide basically is that the uncertainty related to the current episode from SARS-CoV-2 basically is about 3 times as large as from SARS, the first episode of SARS in the early 2000s. Right? So a lot of uncertainty, and this will continue to filter into both markets every now and then, and also into forecasts. So there's obviously a lot of policy stimulus in the pipeline globally, but I think the key thing here is to note that one, given the scale of what's happening, the stimulus is probably not enough. And even in the US, You know, a lot of small businesses, a lot of even larger businesses that are in need are not receiving the help that they were expecting to receive, simply because you know, the process has broken down. There's a huge amount of backlog into the system. Servers have collapsed at the US Small Business Administration, for example. In the UK, the you know, as fast as they'd like to get the stimulus out, they're saying that at the earliest they'll be able to reach small businesses, sole proprietors, etc., will probably be sometime in June. So clearly, between now and then, we have a huge problem when a large part of the economies of the world will probably fall through the cracks. And the second problem with this stimulus is that many countries, given the starting positions or initial conditions, are constrained by high debt levels and also by monetary policy, which has pretty much exhausted all its ammunition. So there's a lot of constrained regions around the world, and the Eurozone is one of them. So a global recession is inevitable. You know, I actually put together this slide about a month ago, or a little more than that, for one of my clients. So now I think clearly we're not talking just about a recession. We're talking about the IMF has called it the Great Lockdown. Noodle Rupini thinks it's approaching a greater depression. So clearly the key questions are the duration and magnitude of this. I think the other question is not just how deep and how broad this recession will be and how protracted, but what will the other side of the tunnel look like? And that's something obviously we're all grappling with. We don't have firm answers because we're in the early part of this crisis, and the fog of uncertainty is very thick, right? So I won't talk about that. I'll make a stab at it, you know, right towards the end when I talk about what sectors are likely to be hit by this much harder than others, and what potential opportunities in terms of sectors might exist. Because, you know, a lot of you, of course, all of you are CFAs. Most of you do this kind of work, you know, with regards to tracking businesses and equities. So that may be of some interest. And of course, it's meant to be, once again, indicative. It's meant to be a springboard for a discussion that I'd love to hear your views as well on what you think. So we'll come to that right at the end. But I think what I really like is, in terms of an apt description of where we are, what Mark Zandi of Moody's Analytics said, and he said this is an economic tsunami. And I think he's absolutely right, because that's the way I look at it as well, that there'll be a huge amount of detritus of global bankruptcies, not just of small and medium enterprises and businesses, but many large businesses, and perhaps some financial institutions as well going forward. So maybe not really large ones. Those will be protected by their respective governments. But nonetheless, we'll see regional lenders and some even larger than that, subnational lenders who will be in huge amounts of trouble globally. So that's the idea of calling it an economic tsunami. Now, once again, this slide is slightly outdated now, but I think the last part of this slide is still valid. And this comes from an excellent background paper that the World Bank did for their World Development Report 2014. And they modeled the economic impact of a global pandemic. And according to that work, in a severe scenario, about 5 percentage points would be lopped off of global GDP for 1 year, for the first year, and the effects will be fairly protracted. So the economic effects will linger, and there's another paper by the San Francisco Federal Reserve Board, and they've looked at the 1918, the economic effects of the 1918 Spanish flu, and they found that some effects, a lot of the effects lingered for about 10 years, and some effects lingered for about 40 years. So clearly, this is not, this is really an unprecedented environment that we are in. Now, I'm just going to skip through this because what this basically, all we're saying here is, and this is adapted from McKinsey, the first few bullets, what we're saying is that the economy's path will follow that of health. So the economy will, and both in global terms and also in terms of Pakistan, the economy will only come out of this when we're out of the health emergency. So the trajectory of the virus, it's how far it spreads, how long the effects linger, whether there are resurgences or not, what are the efficacy of the health measures that authorities put in place, and then purely in terms of the economic impact, how robust are the economic measures, countermeasures that the governments would put in place. Obviously, all of this together will determine what is the final impact on economies. Now, in terms of Pakistan, obviously I'm not an epidemiologist or a virologist, but I think just looking at it in a common sense way, I think there's a high degree of vulnerability to contagion. And I think some of the numbers that people are looking at, of course, the last 2 days, the numbers have become worse. But so far, the numbers people were looking at had a lot of noise in them. And really, they weren't really reliable simply because the amount of testing that we should have done, in the tens of thousands per day, we were only doing a fraction of that. So we were not capturing the extent of the spread of the contagion. And people are also saying that the other side is that, the morbidity rates or the case fatality ratio seem to be low because that you cannot suppress. And there too, I think in the last few days, we've seen some skepticism on those numbers simply because a lot of people are either not making it to hospitals or they're being rejected from private hospitals, and their cause of death is not being recorded properly. So we're not really sure. There's a lot of noise about the numbers. My own sense is that we have a high degree of vulnerability to contagion because of cultural factors as well. And the fact that we've had, other than Sindh, we have a policy of a partial lockdown and a fairly confused messaging from the federal government and in Punjab as well. So I think for all these reasons, we should expect that the contagion is going to be around for a while. Some epidemiological models that I've seen, and they're fairly reliable, fairly credible ones, they predict for Pakistan, so they do it for a number of countries based on the data that they've seen so far that they put into the model. They predict 2 or 3 peaks in the case of Pakistan. A resurgence, and this is fairly, fairly typical. It's not atypical, as many of you would know, that viruses, typically the large influenza epidemics or other ones, have a number of smaller peaks. So a very large peak and a secondary peak and then a tertiary resurgence as well. But bottom line is that whatever the impact of the health situation is, it's unfortunately also going to be compounded by global conditions. And, so I think this slide would be apt to talk about that because we're not immune or insulated from global conditions. Obviously, as this slide would show, that there is a fair degree of or a significant correlation between global economic growth and Pakistan's growth. So this is advanced economies in the blue line and Pakistan's annual GDP growth rate in green. So I think obviously what happens to the global economy impacts Pakistan as well. And the channels of impact are obviously a few. On the positive side, there's lower oil prices, there's a disinflationary environment, there's lower interest rates, which is already coming about. And this should provide fiscal space to the government. And overall, in overall terms, these 4 channels of impact are all growth supportive. However, the positive impact will be limited because we'll have low confidence, we'll have some degree of fear that will linger on, and a high degree of disruption to the economy because of the health situation. And then also that, unfortunately, the government does not seem to be breaking out of a fiscal consolidation mode. Now, they talked about a fiscal stimulus, but to be honest, it still reflects very conservative thinking, and it's completely asymmetric to the scale of the challenge that Pakistan is experiencing. The State Bank of Pakistan was behind the curve, and now it seems to be catching up. But the Ministry of Finance is really behind the curve. I don't think they're really being able to grapple with the nature and the intensity of this crisis. So unfortunately, I think we'll have these positive growth supportive impacts that will be diluted or offset to some extent by some of the conservative policy making approach that the Ministry of Finance may continue. Now, the negative channels of impact are obviously no less powerful. In fact, I would argue they're probably more powerful because you have lower exports. We'll have pressure on government revenue, yes and no. I mean, largely yes, because the economy is in lockdown mode, whether it's one extended lockdown or it's a partial lockdown, but rolling lockdowns, a series of successive partial lockdowns. Irrespective, there'll be pressure on government revenue. There'll be a huge amount of potential pressure on remittances. Hot money is already, the book is pretty much gone. There's a balance, about $1 billion or so left. There could be equity outflows as well, more accelerated equity outflows because there's a flight to safety environment globally. And our access to international capital will clearly be disrupted. I put a question mark there because it depends how soon the global economy comes back up. But in my base case scenario for the global economy as well, there will be a rupture for a while in the global financial markets as well. So our access to international capital is likely to be disrupted. Now, the working assumptions for my base case, the global assumptions are that, like I said, there'll be one peak followed by a second smaller peak, and this is likely to continue in the global scenario as well till about the third quarter to, so anywhere between September to December this year, the effects of this virus are likely to linger. Consumer and capital spending is going to be depressed. Then there's going to be a huge amount of disruption to the supply chain, logistics, and the marketing channels. And that's obviously going to be an important factor for our exports, especially in the US. Once again, important in the US is bankruptcies, not just store bankruptcies, but also, like I said, the marketing channels for our exporters. So that's going to be important. There'll be sovereign and corporate debt workouts that are going to go on for a while because the scale of the debt workouts required and the fact that the financial system will be under stress, I think this is going to take a long while to tackle, and therefore the credit channel is likely to face a degree of disruption for a while. Right? So that's the base case scenario globally. For Pakistan, like I said, we're likely to have 2 or 3 episodes of resurgence locally, and it means that the government policy of lockdowns, obviously there'll be rolling lockdowns that they'll lift the lockdowns for a large part of the economy, then they need to bring them back on. Excuse me. And I think this is likely to continue till around December for Pakistan as well. Exports remain affected, but a key assumption is that the agriculture sector is unimpacted. Now, of course, there is likely to be some degree of productivity loss in the agriculture sector because not all farmers will be unaffected health-wise. Not all of them will be able to come to the fields now to, of course, harvest wheat, later on to plant cotton, and but I've assumed that that effect is not very significant. In my model, it's about a 10% productivity loss, which produces about a 0.2%, 0.25% loss to GDP or thereabouts, but nothing catastrophic in terms of the agriculture sector. But of course, consumer and capital spending are going to remain very depressed, especially capital spending. Even with the construction package or whatever, that's going to take quite a while before we see a return of capital spending. But the good news, of course, is that there'll be enhanced multilateral emergency assistance. We've already received 2 tranches, one from the World Bank, one from the IMF. The ADB, to my understanding, is also preparing an emergency relief package for Pakistan, for many other countries. And then, of course, the G20 has already talked about bilateral debt relief. So far, it's bilateral debt relief. So in my working, I've not taken multilateral debt relief. But my understanding in background discussions with the IMF is that clearly there's a lot of talk about suspension of multilateral debt payments to countries like Pakistan as well, right? So that's not been factored in right now into the model. So far, it's just bilateral and official bilateral debt relief, along with commercial creditors. That's important as well. So it's Paris Club, non-Paris Club, London Club. And these are the assumptions, main assumptions for oil price. I've been slightly conservative. My own gut feeling is, to be honest, that oil prices will probably head lower. But I've conservatively kept them at $25 for my base case scenario. The export loss is 13% this year, roughly about 20% in the next fiscal year. Remittance loss about 20% decline in next year. Saudi oil facility, it could continue, and that could be a positive for Pakistan. I've assumed, given our experience, given my gut feel, that oil prices will be lower. And our experience in 98, 99, when oil prices came down to $9 a barrel, and we had the Saudi oil facility, which they then asked us to, they wanted to stop that, obviously. They suspended that simply because they said, it doesn't make sense. You can buy oil at $9, so the oil facility doesn't make sense. So I've assumed, to be conservative, that it will be discontinued, but at $25, it may not be discontinued. Nonetheless, the Saudi budget is under pressure, as we all know. So they may discontinue it next year. And then exceptional assistance, $3 billion this year, and then roughly about $3 billion next year. And this includes both cash assistance, grants, as well as debt relief. I'll skip this slide. It's slightly confusing because this is from the baseline. So 2021 is actually from the baseline. This is lost from the baseline. So I'll just come straight to my forecasts for this year, next year, and the year after that. And I think clearly what you'd be interested in is what is highlighted here. So I expect GDP to contract next year, not this year, unlike the IMF. But next year, I expect it to contract. Either in the best case scenario, it's going to be flatline, but it's likely to contract about 1.5 percentage points of GDP. But to be honest, this is fairly, this is fairly sensitive to when the economy opens. So I've assumed the economy opens up in December. If it opens up in Jan or Feb, God forbid, then of course this is going to be it's going to be larger, the contraction. Now inflation is, so you would expect inflation to come down even more. So let me explain the inflation forecast. Aggregate demand obviously is not going to be there in the economy, so inflation should come down simply because the oil prices come down to $25 and there's an absence of aggregate demand. However, two things will probably shape the response of inflation, and conservatively I've kept it at 7%, but the range, my range goes from about 4.7% to about 7.5%. So this is a conservative number. And the reason it's slightly conservative is because I don't expect the government, given its revenue situation, to pass on a significant portion of the decline in international oil prices to domestic consumers. So given the conservative approach at the Ministry of Finance, they're likely to to gravitate towards keeping a bigger portion. But let me give you an idea of how sensitive this is to how much the government keeps and how much it passes. So if the government, so this 7% is predicated on a 30% pass through and a 70% capture by the government. If the government passes on 50% of the decline to domestic pump prices, then the number is 4.7% inflation, right? So it's, the range would be 4.7% to 7%. I've been conservative at 7%. Now, you would notice two things. So I think it's only fair to point out two things. You would notice the absence in these forecasts of a policy rate forecast and an exchange rate forecast. And I think I'd mentioned to Asim initially to the CFA Society, excuse me, that since those are client privileged, I will not be presenting them directly. So I hope you'll forgive me. But I think you'll be able to get a sense of what the likely ranges are going to be that I'm looking at, given where I'm projecting inflation and given where I'm projecting the last line, the last row, overall balance. So this is not just a current account deficit. This is, of course, below the line, the capital account and the financial account as well, and the emergency, the exceptional assistance, and the debt relief. So all combined for 2021, I think the overall balance in aggregate terms over a 12-month period is likely to be in positive territory. And we should be able to build up reserves by about $4 billion at the end of that year. So that will give you some idea of what I'm thinking, what is likely to happen to the exchange rate. But mind you, this is aggregated over a 12-month period. Therefore, there'll be a lot of volatility between now and end June 2021 in terms of the exchange rate as well. Now, finally, I just want to show you a couple of slides, but one slide related to growth. I thought that this would be important. So if our forecast for growth is correct, or anywhere near correct, so a contraction of about 1.5 percentage points in 2020-21, and then a rebound, if you like, a relatively weak rebound to 3 to 4%. So then what this produces is what we call the impulse response function, or basically the trajectory of growth from time t. Time t is when a shock occurs, and I've actually taken time t to be the start of the IMF program in comparing 2008 with 2019. So the blue dots are the trajectory of GDP growth relative to October 2008 or fiscal year 2008-2009. That's been set as 0, and then how we moved up from there. And you can see that pretty much was what is being called now stylishly as the Nike swoosh. So actually we had a Nike swoosh in 2008 onwards. This time round, we are going to have a bit of a V-shaped thing, but spread over 3 years. So actually, if you account for that, it's more U-shaped than a V-shape. But I thought that would be important to have a look at this. Finally, just last 2 slides, because many of your analysts that cover a lot of these sectors, so I'd just like to share some of my thoughts on this. For those of you covering banks, I think clearly by now, I mean, I produced a slide a few weeks ago before the G20 communique, but clearly now I think you should be factoring in that not only will there be a Paris Club process for debt rescheduling, but there will be a London Club process as well. So a lot of commercial creditors, in fact, depends what the cutoff is likely to be in terms of date, etc. But a lot of banks with heavy exposure to the government of Pakistan are going to face some degree of haircuts on their loan portfolio, right? So I think that you need to take that into account. Now, exporters of textiles and clothing to the US, because I think, I could be wrong, but my background discussions with large exporters leads me to believe that the US market is going to face a bigger disruption in terms of marketing channels, etc., So the disruption for our exports to the US is going to be larger than our disruption to exports to the EU. So I think that's something you need to factor in. And initially, a lot of the corporates, a lot of exporters, etc., are going to face liquidity issues. But ultimately, the liquidity issues, as we all know, translate into solvency issues, right? So I think you need to be a bit careful as well. Then consumer discretionary is a no-brainer, and it's not just the consumer discretionary sector, but it's of course the suppliers to consumer discretionary sector. So you have the steel, the motors, tires, etc., electric motors, tires, etc., rubber, and the various things. Another no-brainer is travel, tourism, and leisure. The oil and gas sector, with prices where they are, of course, the economics of the sector gets disrupted. And paradoxically, even with the oil and gas sector hurting, you would expect the renewables to be, sort of then doing better. But because the oil prices are so low, then of course, the economics of producing thermal generation is far better than moving to renewables. But the capital cost of renewables has fallen very significantly. So that's why I put a question mark. I'm not an expert on that, and I just sort of, put my gut feel here that renewables could also be a question mark. The IPPs, now this was before the Muhammad Ali report. So clearly, I think now we know that they are under pressure. And of course, coming back to banks once again. So this was specifically for bank alcos and bank senior managements. Everybody needs to look at their financial counterparties. So you need to work out who is at risk, because whose lending is at risk. And then you need to work out, which financial counterparties are at risk as well. So that's something that we need to look at. Potential opportunities. Once again, no-brainer is the healthcare sector, pharma. Anybody who can capitalize on the current environment. So medical devices, personal protective equipment makers, health technology, and I put health technology there because Pakistani, not just the software guys, but even the tech guys, they're quite nimble and they're quite agile, and there could be some opportunities in this sector here for them, and for lenders, therefore, looking out to them. So construction is beyond the short term. I don't think anything mega is going to happen in the next 6 months. This is entirely contingent on how the health situation plays out. I don't think we'll see a boost to the construction sector, or can see a boost to the construction sector when there's so much uncertainty vis-a-vis how the virus is, how the contagion or the outbreak is playing out. Then sectors with petroleum and petrochemical inputs, obviously their raw material costs have come down very sharply. So there's a whole host of them in plastics and fertilizer, solvents and dyes, paints and pharma, once again. Potentially startup new airlines, obviously, that's an if when they come up, but there could be a restructuring opportunity. There will be a restructuring opportunity in the airline industry. And with this huge amount of, with capital costs coming down and a huge amount of availability of, fleet acquisition costs will also be down. So that's something down the road, but this is fairly speculative at this point in time. Logistics and supply chain management, of course, is something that's going to be, people in a time like this have really relied on, or have felt the need for robust supply chain management. And I think this is an area where some more investment is likely to move into, so logistics side of it. And then, of course, online platforms, and a large beneficiary of that will be the telecom companies. So those are my thoughts. I'd love to look forward, sort of hear from you in terms of the questions.
Thank you very much, Sakib Sab. Certainly, the information, the projections that you have shared, certainly, I'm sure would have worried the general audience. And I think, given the nature of the issues that Pakistan's economy is facing and the certain nature of COVID, this is certainly one of the courses that economy can follow. And as you mentioned, that there could be risks that these scenarios could be even worsened further. Uh, I think this economic crisis is probably unique in my observation that we usually have economic crisis with all indicators going in red. For instance, GDP growth along with the balance of payment, which means our inflation is likely to lead to higher, and balance of payment also means our exchange rate is also going to depreciate significantly. But the presentation, the projections, and the account that you have shared, this depicts economic scenario where overall economic growth is likely to remain at risk. The inflation, especially the disinflationary environment, I think for a country like Pakistan, this is something which has not, which at least in my career or over a longer period of history that I followed, I haven't seen. Probably you could share the instances if we had seen this earlier. But I think one important thing is that most likely we will not see a very significant rupee depreciation, as you have shared, that our balance of payment is likely to remain positive because of support from multilateral agencies and the debt moratorium that has recently been announced. Now, in this, as you shared the estimates, we would now be inviting questions from the audience, and small announcement to the audience that you can post your questions through the chat box. So this chat box will be active, and my apologies, you would not be able to let individuals ask their questions individually, given the sizable audience here. So we'll be picking up questions, and in the meantime, I'll request my colleagues to also put up the poll that we did initially at the beginning of event for a fresh response from the audience about it. And my colleagues will try to put it up. However, before that, in the meantime, while they're trying to put it up on your screens, I think it's already there. At the bottom of your screens, you can see a tab of polls. If you click that, you can see the polls and you can post your responses. So this is, I think, still the original poll. Yes, now it's updated and you can put up your responses on the new poll. And while the audience is posting their answers to the poll, I would request Sakib Saab to talk about that. You have talked about Nike swoosh and a 3-year outlook for recovery. Now, Pakistan is already in IMF program. So once this impact is somewhat contained in the Pakistan's economy, do you think that Pakistan will have the flexibility from IMF to pursue the fiscal targets, the monetary targets, as we see that the IMF conditions usually do not allow too much flexibility in those variables? So would first let the audience populate their responses, and would then request Sakib Saab to please answer this question. And in the meantime, the audience can also post their questions in the chat box. I can already see several questions posted here. But first, would request Sakib Saab if you could comment on the that going forward, how would Pakistan pan out in the IMF program?
So I think if you look at the wording of two communiques or press releases from the IMF on Pakistan, and if you parse the language is that, so in one sentence towards the end, they talk about it is hoped that authorities will return quickly to program commitments. So clearly that is indicating that there is some degree of suspension of the program targets. However, the way the IMF works, and in my experience, so they're probably going to recalibrate the targets because obviously everything has changed, right? I mean, the entire model now has to be recalibrated with new sets of numbers. However, the policies that the program espouses, they're unlikely to change. So in broad terms, the structural conditionality is going to remain the same. So the amended SBP Act, the focus on SOE restructuring, the focus on power sector reforms, etc., etc. That unfortunately or fortunately, I mean, depends how we negotiate with them. So that's something that is pretty much going to remain on the table. I think the only thing that we'll see is that there may be some latitude in terms of the documentation drive on the tax side, and how we and what kind of tax targets that we are supposed to follow this year. So, if you allow me, Asim, are there a number of questions starting from Shoaib?
Sure.
I can start answering those. So, in terms of the foreign debt restructuring, Shoaib, I think it's early days right now. All we have is the one communique from the G20, and that very clearly talks about official bilateral creditors, other bilateral creditors, and commercial creditors, right? So this excludes for now multilateral creditors. So I mean, if you look at, if we just focus on these three categories, going forward, if it did not include multilateral creditors, then it saves us about $2 to $2.5 billion of debt servicing cost. If it were to include multilaterals, it saves us close to about $4 billion of debt servicing costs. So this is something which in my background talks with the IMF and the World Bank, they're all sort of working out this issue. It's going to pan out. Clearly, the G20 and the G7 have hinted at multilateral responses as well, but this is not something that's confirmed at this point in time. So the second part of your question was, can we expect deferment only or waivers too? I think for now, it's a standstill. It's a suspension of payments. But I think clearly, given the scale of the devastation that this is causing for developing countries, we'll really go through a process where there'll be a restructuring and a haircut for creditors, and our debt will be restructured. But that's going to take a while. It's going to be a fairly involved process, like all Paris Club, London Club processes are. So that's going to take, I think, 1 or 2 years perhaps before it's cobbled together. The second question is from Musa Khan Durrani, and it says GDP contraction and the expected stimulus package. Why do you expect a meager 7 to 8% fiscal deficit? Simply because I think the fiscal deficit is a sleight of hand to a large extent. And I'm sorry, the DG debt is here as well. And he's asked me a question later on, but it also sort of goes into your, sort of partly answers your question as well. This is really a very conservative approach. So if you put in, so two of the key elements of the so-called, I wouldn't call it a stimulus package. Clearly, there's no amount of stimulus you can do in a situation like this. It's an emergency relief package, if you like. So what we should have seen is a huge wage subsidy given to businesses across the board, like it's happened in the US and UK and many other countries. So we would ask businesses, large, small, registered, unregistered, in any way that we could. Obviously, unregistered ones would be difficult. So the methodology or the process of this is important, and that's a big question mark. But purely in conceptual terms, we should have given a huge wage subsidy to businesses and said, if you do not fire your employees for the next 3 months, we will pick up a large portion of your payroll or the entire portion of your payroll, maybe 50% of your payroll this way or 30% of your payroll this way. And it should have been supplemented by something which the state bank should have done early on. This is all something which I, by the way, I've already enumerated this in my op-ed 4 weeks ago. Previously a bolder policy framework, and then I repeated that about 4 weeks ago in my op-ed of what should be done. And this should have been complemented by interest-free loans to businesses. Once again, for payroll, to make sure that people are not fired. So that's a huge part. Unfortunately, what the government did, or the Ministry of Finance has done, is it's added wheat procurement, which it was going to do anyway, so about 280 to 300 billion rupees of commodity financing or wheat procurement. That's been added into the package, and then it's added. It's brought forward the SRs payments. So it's not additional money, it's not new money. It's a good step, but it's not enough. So I think the Ministry of Finance really is behind the curve, and spending new money of 400 to 500 or 600 billion rupees, given the scale of the problem, is not going to be enough. So I hope that answers the DG debts question as well, why I think the MOF is behind the curve and what kind of fiscal stimulus would have been appropriate. So given that they're not going to be spending enough, I think broadly, given the conservative approach of the Minister of Finance, the Finance Minister, I think they'll try to remain close to the IMF targets, and therefore not allow the fiscal deficit to go up in a big way. By the way, and this is probably going to shock many of you, I've already mentioned in my Dawn op-eds the need for not just the wage subsidy or the interest-free loans, but also helicopter drops. So to some extent, the government is doing that through the SRs program. But one implication of that also is that given that we're talking about possibly a deflationary environment and not just a disinflationary environment, there is scope for borrowing once again from the central bank. I think a key thing we should do is, or we should have done is, and once again to the DG debt question, is we should have suspended the IMF program for 1 year. Or not the program, but the program targets. So right now, they're talking about a suspension of the next few months, but I think we should have suspended our program conditionality or negotiated to suspend a program conditionality for 1 year. And within that space, we should have started borrowing. Once again, the government of Pakistan should have borrowed from the central bank. Given that we are in a deflationary environment, this would not have been inflationary. So any resource constraints could have been picked up from the central bank borrowing as well. So that's my view. I think we need to be radical. We need to be, this is exceptional circumstances, and exceptional circumstances call for exceptional policies very clearly. Sakib Sajjad has asked whether I see a risk for stagflation in 21 and 22. So in 21, FY21, no. I'm talking about a deflationary environment. If not a deflationary environment, then clearly a disinflationary environment that will remain throughout. The only way inflation comes back into the system is if oil prices, international oil prices go back up to $30, $35 essentially, or higher, excuse me. Or if there are temporary supply disruptions for the food chain, and those supply disruptions, if they're temporary, then there'll be a temporary spike in food inflation. But somehow, if those disruptions are a bit longer than temporary, then of course that inflation will be there for a while. But generally, I don't see a stagflationary environment for this year or the next fiscal year, at least. Jawad Shamim, I've already answered the fiscal deficit question. At least that's my view. So in a conservative setting, a conservative approach, excuse me, I would have liked to see a higher fiscal deficit, but I don't think we're likely to see a higher fiscal deficit. Um, so Harun Ilahi has asked about how do I see steps, taken by the state bank here versus what RBI has done in India or what the Bangladesh central bank has done. Um, so I think, generally I actually think, given that what I would like to see, RBI's actions are closer to that. And I think, but the good thing is the State Bank of Pakistan is catching up. And I think I expect the State Bank to roll out a few to address the missing gaps that they have in their facilities that they have so far. So one of the things, for example, is two things that I just mentioned that come to my mind right now. So I talked about interest-free loans. So they've talked about a refinance facility where the final borrower pays 5%. I think that's not really, in an environment like this, having a facility where you have to pay an interest is really not on. Secondly, their interest facilities are going to be, so, the banks are not a really big missing gap or a missing area in the state bank package so far is they need to provide a credit backstop to the banks. Banks are not going to lend to the SMEs without that credit guarantee from the State Bank of Pakistan. So really, I think the State Bank is also a little behind the curve in some key ways, but I think I expect them in the next few weeks or so to catch up. And these are the kind of things which the RBI, I'm not so sure about the Bank of, the Bangladesh Bank, Central Bank, but I know that Bangladesh's fiscal stimulus is about $8.5 billion. The first tranche that they've announced is $8.5 billion, and that sounds fairly substantial for Bangladesh. And that's the kind of thing that we need to announce here in Pakistan as well, scaling up to the level of our GDP. So Umar Naeem, is the global downturn an opportunity to internationalize faster? Right now, I think, the global supply chain. So what's going to happen, in my view, is that there's going to be a lot of emphasis on anti-globalization, on protectionism, nationalism in the advanced economies, and a logical outcome of that will be reshoring rather than outshoring. So I think the opportunities to be part of global value chains is actually going to constrict rather than expand. And that's going to pose a huge challenge to countries like Pakistan and other emerging markets, how to reposition ourselves in this new world where our growth model that we were trying to base ourselves on of export-led growth is going to actually face a huge headwind. I think that's going to be a big question mark. Umar Kamran on the PSX. Yes, I think the markets are running ahead. The markets are very myopic. So they work on news flow, on a daily news flow basis, and unfortunately don't tend to be very strategic. I think if you look beyond the nose, there's a huge amount of uncertainty. And I think at some stage it will catch up with the markets here as well. Mustafa Subhani, I hope I've answered your question as well. I've spoken generally about the kind of policies that we need to look at. Shoaib, yes, we don't have a choice, unfortunately. We will continue with the current IMF program because the IMF program, as you know, is not just the anchor for the entire external financing construct, but it's also a requirement for Paris Club and London Club reschedulings. So we will have to remain on the IMF program, and I think the Ministry of Finance will think in those terms at least. Taha, why do I not expect GDP contraction? Simply because we've had 3 quarters of growth, and this has really impacted us in the last quarter. And I think there is a possibility that there will be a contraction, but right now, I've actually expected that this is going to take about 1% points off where we would have been without the coronavirus situation. So a large part of, in my estimation, I could be wrong, a large part of the problem actually, or the GDP contraction or GDP hit, is going to come in FY21 and here not in FY20. So that's why I still expect a positive growth rate, even though a muted growth rate for FY20. Do we expect restructuring by PSCs or a cut in government instruments? I'm not sure, Satish, what exactly the question is, but generally in a London club environment, what will happen is that all commercial lenders or creditors to the government of Pakistan earlier than a certain cutoff. So the cutoff will have to be decided. All those facilities will need to take a haircut. So that's how it works normally. Wajid Rizvi, what premise compels you to assume December 20? Your guess is as good as mine. There's no premise. So I'm not really sure. I've just assumed from my model, I've just assumed December 20th. Unfortunately, it could be longer. Hopefully, it will be earlier, and that would obviously change the forecasts. So, Asim, if you don't mind, I'm going to be a little selective in answering the questions.
Sure.
If there's anything you would like me to answer and I've not, please highlight that as the moderator. But so some of these I've already answered. Mohammed Waqas, obviously is trying to sneak, one on the dollar rupee parity, which I'm not going to answer, as I've said before. You can assume from my forecasts what I'm looking for in terms of the dollar rupee parity. Because I'm thinking about the overall balance being in positive territory, close to $4 billion, which would obviously mean that there's less pressure or no pressure on the exchange rate going forward. But like I said, it's really important we aggregate on a 12-month basis. And a lot of these things may happen in the second quarter, third quarter of the next fiscal year. And therefore, we may see a lot of volatility between now and September, October of this year in terms of the exchange rate as well, right? So keep that in mind. So yes, Mohammed Umair has asked whether the debt deferment can result in a delay for fresh Pakistan Eurobonds issue. So I would actually, urge you to read the G20 communique because they've clearly said that this standstill will be available only, and this is bizarre. I don't know why they put this clause in. Of course, it's a protection clause for them, but there is some talk that they may actually reverse this. But they put this in, and it's here for now, it's something that we need to keep in mind. So in the G20 communique, they say that this will be applicable, the debt standstill, to those countries that do not seek fresh, non-concessionary borrowing. So clearly, yes, that means they're expecting Pakistan not to seek market-based borrowing or commercial borrowing. And this is fairly bizarre because this constrains us quite a bit, but that is part and parcel of the first G20 communique. So please do read that. Maybe my understanding is wrong, so if you actually read that, that will give you some indication of what the answer would be to your question. So Ashraf Baba is asking about the FATF issue, and I fully agree with you. Yes, we've received considerable latitude and leeway here, and yes, the construction package will also, the FATF is our FATF negotiations or situation has been taken into account in the construction package. This is my understanding. Now, it's an interesting question from DG Debt about about the future of the major global economic powers. I won't answer that right now. I think there's quite a lot on the plate for Pakistan. It's an interesting question, and we can come to that. And hopefully, at some stage, maybe the DG Debt and I'll meet face to face and talk about this. So Umar Kamran is talking about the breakdown in supply chain and leading to a spike in food. And yes, many economist friends of mine have also spoken about that. I personally think in the case of Pakistan, it's unlikely. In the case of the UK or Europe or Eurozone or the US, quite likely. But even there, those disruptions, in my view, are going to be temporary. But in the case of Pakistan, I think generally our farmers and our agri supply chain is fairly robust. They work through many kinds of issues, earthquakes and pestilence, etc., etc. So I think our supply chain disruptions are not going to last too long if they do happen at all. So Ali Asad Ghani has asked something about FDI inflows. In my external sort of account outlook, I've assumed very depressed FDI inflows, and even that actually, to be honest, seems to me that I'm being a bit optimistic, because in this environment, I would actually say, in a conservative basis, we should assume zero inflows for FDI in FY21. It's very unlikely that capital will move around in this kind of environment, but who knows? So I've taken $500 million of inflows as FDI, but right now I don't think they'll be looking to take opportunities beyond the CPEC kind of already money that's coming into CPEC projects. I don't think M&A opportunities are really going to be something that FDI investors or direct investors are going to be looking at least in FY21, possibly FY22 and later than that. Jawad Naeem once again is asking about where the cutoff is, where we will start seeing an economic depression. I think that's difficult to say, to be honest. Right now, obviously, we're talking about purely in terms of the US. We're talking about the first quarter, the second quarter, but I think it will become quite clear by the third quarter whether they're heading towards a depression or not. Because if there is what the IMF has called economic scarring, if that will become clear by the third quarter. So I've spoken about the detritus of the economic tsunami, that will all become clear, whether global bankruptcies, debt workouts, failures of small businesses, etc., how large that is. So I think I would say by the third quarter of this year, we have a better handle on that particular thing. Faizan, I've already answered that. I've actually shown a slide as well. So in my scenario, the recovery is more U-shaped than V-shaped, because that V-shape is over a 3-year period. So it's actually a U-shape, but there is a danger that it could be L-shaped as well. And yes, Umar Naeem, you've asked about the effect on CPEC implementation. Yes, there could be a fairly significant impact. I think a lot of these projects in the PSDB, etc., their rollout will be impacted and they'll be put on hold or on the back burner. So I think I would look at. So Shoaib has asked an important question. I've factored in $2.5 billion as a result of the G20 announcement. The media is quoting, is it $12 billion? So I think if that is the case, media is quoting, then I mean, you have an option of relying on the media or relying on a slightly more nuanced view. Shoaib. $12 billion is the annual debt servicing that we incur. Not all of it is under standstill, and not all of it is likely to be under standstill. So I think if anybody's talking about $12 billion, they're really sort of being overly optimistic, or not just being optimistic. I think they're completely missing the picture so far, right now, as things stand right now. Yep. So I think pretty much I've covered most of the questions. Asim, anything important that you think I've missed you'd like to ask?
Ji sir, there are a couple of questions if you could just talk about. First of all, if you could elaborate more on the liquidity environment, because you mentioned that balance of payment is likely to remain positive. The government is also going to spend a lot in terms of fiscal deficit, as you mentioned that the government would need to support the overall economy as well. So how would be the local liquidity environment, domestic liquidity, and what is the trickle-down impact in terms of the masses and the general business segments? And the second thing, if you could talk about, is the challenges in the energy chain. In this scenario where demand has significantly reduced, we have heard about that this reduction in demand is flowing back to E&P companies who are looking to, even because of two challenges. First, the overall circular debt, and the other is that oil and gas marketing companies not able to lift up the entire the production of refineries being shut down as well. So how does this pan out, this energy situation? Because for the last 4 or 5 years, this has been the huge challenge for the overall economy. And so how would things pan out there?
So yes, in terms of external liquidity, I think our international liquidity environment obviously is going to be better in FY21, despite exports crashing or facing significant disruption, and despite remittances, projected to come down at least 20%. But because imports are coming down as well, and there's below the line relief that we get, both in terms of emergency assistance and in terms of debt relief. So the external liquidity environment will look pretty good. The domestic liquidity environment, I don't think is going to be impacted. To be honest, like I said, this 1.3 trillion or 1.2 trillion package from the government is really is neither here nor there. It's too little, too late, in a sense. Maybe not too late, because hopefully they'll build up on this. And it also is, takes into account already spending that was going to happen anyway, right? So this is not additional spending. This is not new money that's going to filter into the economy. This is not new money that's going to increase the fiscal deficit. It was already part and parcel. Large part of it was already factored into the fiscal deficit calculation for next year. So I don't think there's going to be a big impact on the domestic liquidity environment. And secondly, because the government is not going to be a large borrower and aggregate demand will have collapsed, there'll be almost no capital spending next year as well, for at least the first half of next fiscal year. So I don't think there'll be a lot of pressure on liquidity of the banks. So I think banks will continue with a very liquid environment, domestic liquid environment as well.
Thank you. And the second question with regards to the energy chain and the energy outlook.
Yeah. So if you go back to my slides, the first slide on lending at risk, clearly the energy chain is there for the reason that you mentioned as well. Low demand, and for the IPPs, the implications of the Mohammed Ali report, commission report, all those will actually put a big question mark on the energy chain, not just the IPPs, but the E&P companies as well.
Okay. And do you think that in this environment, the circular debt, any solution, do you think the government is working on? Do you think that they are working in the right direction, and is it likely to improve going forward?
In overall terms, this overall
Yes.
package. So I'm more hopeful about the state bank, to be honest. I think their initial reaction was 75 basis point cut and launching a facility for new businesses, for new investment. So clearly they were really behind the curve there. And they've caught up since in the next 2-3 weeks, they've caught up quite sharply. So I think the state bank is talking, I know behind the scenes, talking very aggressively to banks, financial institutions, and to large businesses, the export sector, etc. So I have more hope about the state bank catching up. The Ministry of Finance, unfortunately, is on a different planet as of now. Sorry, DG Debt, but that's my situation. That's my outlook. They have a lot of catching up to do. They have a lot of work to do. I think in understanding the nature of this problem and in putting together a symmetric response, fiscal response. A large part of the action needs to be on the fiscal side, and we don't see it so far in the package.
Sir, एक चीज I would like to ask again. We have been conservative. हमने एक scenario की भी बात की कि ये extend भी हो सकता है. You have already assumed the scenario कि जिसमें शायद ये extend हो सकता है. I think by the end of this calendar year. What if it gets contained? अल्लाह करे ऐसा हो जाए. And gradually जो कि scenario लग रहा है कि it becomes globally there are talks about कि it becomes a part of life. We contain it. And the life continues on with again on an adjusted curve sooner than expected. So how would be the reaction again? In IMF program, debt moratorium is there, relief so I think is announced. So what would be the overall situation?
So Asim, the way I look at it, and I know for a fact that some much better, equipped people friends of mine were supposed to join this. I don't know if they have. They've read many more books on, on virology and epidemiology than I have. But the way I understand it is that the only way this can be contained sooner. So there are two scenarios. One is that the government imposes a very aggressive set of measures, lockdown, upfront measures. But when you relax those, the virus will resurge, right? I mean, there will be a resurgence of that. So then you can't stop it. So it's a series of rolling lockdowns that we are in. The other way the virus goes away faster than when we think at this point in time is that there is a faster herd immunity that's built in the population. So, the R is significantly, it's like greater, it's around 3 or thereabouts. And we built up a herd immunity without realizing it in the case of Pakistan at least. And that also doesn't seem to be the case at this point in time. It's going to take a few months till we get there, given how large the population is. And the third scenario is that there is a vaccine that's developed much faster than we've assumed. So आपने बिल्कुल दुरुस्त कहा, अल्लाह करे ये इनमें से कुछ ये तीनों सिनारियोज हो, तीन तो ना हो, herd immunity वाला ना ही हो तो एक क्लास से बेहतर ही है. But a vaccine comes about much faster. Clearly, then things will look much better, not just for Pakistan but for the global economy as well. So let's hope. But at this point in time, we're just running with the flow.
Thank you very much, sir. We would, I think, go away with this hope, back to our work, and realize that this effect is contained, our economy is back to normal the sooner than is currently being considered as a risk. And we hope that life is get back to normal. Especially for a country like Pakistan where things are very vulnerable. So with that, you can see be on your screens the results of the polls as well. Uh, so this program recording would also be available on our website. And Sakib Saab, I think we have your permission to share the presentation with our audience as well. So with that note, I would like to thank Sakib Saab for sharing his thoughts, and would like to thank all the audience, all the participants here for attending this seminar. Thank you very much.
Thank you, everyone. And Khuda Hafiz, stay blessed and stay safe.